In the last video, what an option is, and the 4 scenarios at the contract level. Now we actually trade ones. Today, long calls and long puts as your first directional trade. The full payoff math, 3 outcomes, and how this stacks up against just buying the stock. Apple is at 150. You buy 1 call, strike 155, premium $3. Downside is capped at the premium, max loss is $3. Breakevens sits where the option recovers what you paid. Strike plus premium, 155 plus 3. Apple needs to reach 158. Above 158, every dollar of move is profit. Max profit has no ceiling, it scales with the stock. Worst case in percentage terms, minus 100% of the premium. But the upside is open-ended. A move from 155 to 170 returns over 4 times what you paid. 3 scenarios, same trade, different endings. Scenario 1, Apple drifts down to 145. The option expires worthless. You lose $3, negative $1. Scenario 2, Apple lands at 158, right at breakeven. You get back what you paid, $0. Scenario 3, Apple rallies to 170. The option is worth $15, profit 12 plus 4R. 1 trade, 3 outcomes, asymmetric in your favor. Multiply by 100 shares per contract for the $P&L. Long puts work the same way, mirrored. Apple at 150. Buy 1 put, strike 145, premium $3. Breakeven is strike minus premium, 142. Apple at 125, plus 6R. Apple at 155, minus 1R. Same shape, same math, opposite direction. Now compare the long call to simply buying the stock. 100 shares of Apple at 150 costs $15,000. 1 call contract, $300. The same 100 shares of upside exposure for 2% of the cash. If Apple rallies $20, the stock gains 13%. The call gains 300%. If Apple drops $10, the stock loses $1,000. The option loses $300 and never more. But options come with a clock the stock does not have. Even if your direction is right, a slow move costs you premium. Time decay eats it as expiry approaches. Less capital, more leverage, capped loss, but you are racing the clock. We cover time decay in detail in the Greeks video ahead. Inside ArcAlpha, before you express a directional read as a long call or long put, look at ArcFlow. ArcFlow surfaces unusual institutional options activity, real money positioning ahead of moves. When ArcFlow shows aligned flow, large bullish positioning on a name your read says is bullish, you have confirmation that institutions are leaning the same way. When ArcFlow shows the opposite, heavy bearish flow on a bullish read, that is a flag to pause and re-examine. ArcFlow does not tell you what to do. It tells you whether the smart money agrees. Next in this track, strike selection in detail. Why one strike fits your conviction better than another. All ArcAlpha educational content is for informational purposes only. None of this is a recommendation to buy or sell any security.